Good afternoon, everyone, and thank you for joining us in the second edition of APREA's Asia Pacific Investors Connection Forum. I'm Cedric Chalcita, the CEO of APREA, and I'm joining you from Singapore. Now, this year's forum comes at a time when APREA has just announced a broader coverage that includes both real estate and infrastructure, and creating a real assets community that values sustainability, diversity, and transparency. Now, while the pandemic's impact continues to weigh on some parts of our region, we envisage the forum to be a channel for sparking discussions on laying the foundation for a more inclusive, greener, and a resilient region, strengthening our institutional framework. So all of this are designed to help our investment community in navigating our region as they increase their capital allocation towards Asia Pacific. Now, I would like to acknowledge our planning committee for making this forum a success, getting this together. Their advice and perspective have been very invaluable in putting together this forum. And they are Martin Sia of Bank of America, Brian Southergill of KKR, Kayer Shah of ADFC Property Ventures, Milton Lowe of AEW Asia, and Chenhua Shen of I Squared Capital. So thank you very much for your inputs in making this forum possible. So with that, I'd like to introduce our keynote speaker for today. We've got a very packed program, but we are so happy to have Dr. Chua Liang, who is Head of Group Research and Analytics at ARA Asset Management. I was talking to Dr. Chua. Everyone knows him. If you've been in the industry for quite some time, everyone knows him. He's a very well-respected thought leader in our community. And we are pleased to have him as well as an active member of the APREA Research Committee. So without further ado, I'd like to hand this over to you, Dr. Chua.
Thank you, Sigrid. Thank you so much for your very kind words. Hi, good afternoon, everyone. So thank you, APREA, for inviting me to deliver this keynote address. So I'm Yang, as Sigrid mentioned. I head up the research and analytics team over at ARA, one of Asia Pac's largest asset manager. So for the next 6 to 8 minutes or so, I'd like to highlight 3 emerging trends that has been rising on the back of APAC's continual economic growth. 1, the need for infrastructure. 2, the resilience of the real estate and capital market in APAC. And 3, the emergence of ESG investments. For a start, you may agree with me that APAC will continue as the primary driver of global economic growth in the years ahead. According to data from the IMF, on purchasing power parity basis, the Asia-Pac region contributed the lion's share of the global economic output at some 40% in 2019. And this is forecasted to rise to over 44% by about 2026. And this is backed by 3 strong social demographical trends. That is, rising population, which is forecasted to reach 5 billion by 2030, up from the 4.6 billion today. A huge working population, right, with a low dependency ratio of less than 47 per 100 working adults. This in compared to Europe, which is 54 dependents per 100 working adults. 3, low median age at some 35 years by 2030, suggesting that incoming pool of young workforce to drive our economic growth and fuel the real estate demand. Additionally, the growth in the services industry in APAC has been most remarkable, growing at almost twice the rate to the rest of the world. Half of the world's large economies or companies have also based their headquarters here in APAC. And APAC is the only region that has recorded a growth in Fortune 500 firms at over 40%. That's between 1995 to 2019, while America and EMEA recorded declines. Now, all these have supported office leasing demand, of course, driving rental growth in APAC at over 1.5 times of that globally, just before the pandemic. The need for infrastructure. Now, supporting this economic growth is the need for infrastructure. New precincts and towns are built to support this growth, while existing infrastructure connecting the city center to these new growth regions will need to be upgraded. All these urban developments are to support the rising urban migration and income growth, as well as a growing demographical trend. The city of tomorrow, to me, will be multi-nucleic, comprising nodes of sustainable mixed developments where cyber connectivity will be just as important as roads, seaports, and airports. The quality and supply of new and existing infrastructure will be critical in supporting the continual human migration and growth in the years ahead. The Asian Development Bank estimated that the APEC region will need some $1.7 trillion a year to maintain its growth momentum. Currently, some $900 million US dollars are invested annually, leaving us an investment gap of well over $8 trillion over the next 10 years. In my view, driving such a large infrastructure investment requires greater collaboration between the public and private sectors. Traditionally, most infrastructure projects have been financed by the government. With population growth in emerging countries, the demand for infrastructure is evident, but the local government are either not familiar or do not have the financial muscles to administer the numerous projects needed. And equally, the government of developed economies with their aging population will also find it increasingly hard to allocate the budget required to upgrade the existing infrastructure to a level that's accordant with modern technology and expectations. There is opportunity for greater private market participation, but this is not without challenges. Mainly due to the lack of transparency and the high barriers to entry, this market is often neglected by private equity. When they do participate, the private market typically focuses on completed projects where ready revenue streams and the risk-adjusted returns are more attractive. Nevertheless, the economic ambitions of this region should provide impetus to power infrastructure spending going forward. Resilience of the real estate and capital market in APAC. As you know, during the pandemic, we saw the flow of capital into the real estate market contracting as global travel came to a standstill, while investors waited on the sideline for more clarity. While Asia-Pacific markets suffered, but given our experience with SARS, our cities were much quicker to impose social lockdowns and contain the spread of the pandemic, better than Europe and North America, at least at the beginning. The contraction in real estate activity in Asia-Pac was just about 10% in 2020, while in America, it was almost severely impacted at 32%, followed by EMEA at 25%. Overall, the contraction globally was less than half of what we saw during the global financial crisis, at just some 20% in 2020. The resilience in the capital market is a testament of the confidence investors have of APAC, although the abundance of dry capital certainly helped too. According to Preqin data, there is well over $43 billion of dry powder available in this year for the real estate sector. This is a 6% increase from a year ago. This capital is likely to find its way into the office, community retail, logistics assets, as well as niche sectors such as cold storage, healthcare, lifestyle, and rental housing, just to name a few. Coupled with the anticipated economic recovery, global investors remain confident of Asia-Pac's long-term growth story. Consequently, investors in North America and Europe plan to increase their allocations to Asia-Pac over other regions in 2021. So according to an NREF survey, 2019 investors had on average some 5.7% allocation to real estate, and that's weighted by AUM. By 2021, this has risen to well over 9.3%, with investors planning to increase it to 10% this year. ESG will come into focus. Now, the realization that the natural event could bring the global economy to a standstill has motivated regulators and corporations to advance their effort to contain the degradation of our shared environment. A direct consequence of this pandemic is a rising demand for green and open spaces and greater hygiene. Firms have emphasized ESG primarily driven by the millennials' increasing demand for sustainability-focused investments and value-driven consumption. Now, according to the Sustainable Stock Exchanges, over 50% of the 105 global stock exchanges, representing about US $88 trillion of domestic market capitalization, have issued ESG reporting guidelines. Now, over the short to medium term, we should expect more sustainable assets. Real estate, after all, accounts for about a third of greenhouse emission in the urban space. Developers and other industry stakeholders on the back of this pandemic will take on the responsibility to provide more environmentally and socially sound projects. Over the longer term, the real estate market could move further along this ESG frontier. Carbon neutrality to net zero, both at the building and portfolio level, should become the norm as government and corporate focus on the Paris Agreement's goal, driven by a value-conscious populace. So in a nutshell, APAC will continue to drive global growth. With the abundance of dry powder, the real estate market in APAC will continue to see strong interest, supported by sound economic fundamental and social demographical trends. The economic ambition of this region should further power infrastructure spending, while ESG will come to the fore as the value-conscious generation demand corporate to take ownership of their carbon footprint. So thank you, ladies and gentlemen. Have a wonderful conference ahead. I'll hand back to you, Sigrid.
Thank you so much, Dr. Chua. What they can gather from you, economic resilience will continue to draw institutional capital into our region. And of course, the search for sustainable opportunities will be a primary objective for many of this new capital coming into Asia Pacific. So as always, your nuggets of wisdom are very well appreciated. Thank you so much. Now, for this forum, we have organized 2 fireside chats with some of our industry's luminaries. The discussions are meant to flesh out some of the pressing themes and, of course, investment opportunities in our region. So with that, I'm pleased to share with you a pre-recorded conversation between Ms. Sarah Cooper, who's Managing Director and Global Head of Real Estate Equity at the Bank of America Merrill Lynch, and she also serves, by the way, as a board member of APREA Hong Kong. And she will be joined by, she's joined by Stuart Mercier, who is Managing Director of Real Estate and Country Head for China at Brookfield. So without further ado, let's listen to them.
Okay, hi, I'm Sarah Cooper, Managing Director and Global Head of Real Estate Equity Sales at Bank of America, coming to you from Hong Kong today. And I'm delighted to be joined from Shanghai by Stuart Mercier, Managing Director and Head of Asia for Brookfield. Stuart's got direct responsibility for Brookfield's real estate activities across Asia. The conference topic today is accelerating real assets, investments and turning towards new sustainable opportunities. I love this topic. I think with the dominance of all of the tech stocks in the S&P 500, there's now a scarcity value for real assets. They give you diversification, they're an inflation hedge, and we all know income's going to continue to be in demand as populations age. So to start, Stuart, what's your view on the case for real assets in the next decade?
Sarah, look, it's great to be with you, and thanks for having us. Obviously, wish we could be there in person, so hopefully it won't be too long before that happens. And I'm sure we'll cover that topic at some point in the next 20 minutes. Look, I think the case for real assets today is better than it has been in a long time. Regardless of your economic view and outlook for inflation, I think, to your point, real assets are, a great hedge against a number of situations where we could potentially see some economic uncertainty. And at the same time, it's a great source of income in an environment where that is proving to be incredibly scarce. The fixed income markets certainly don't provide it. And so the income generating capabilities of real estate and real assets more generally are looking incredibly attractive in this environment.
I agree. Where can we be wrong?
It's a good question. Look, I think where we can be wrong is in the velocity and ultimate destination of interest rates in the next couple of years. It's generally our view that we will continue to see a lowish for longer interest rate environment. It's very difficult to come up with plausible circumstances in which that can change. Nevertheless, many a pundit have been proven wrong over the years in terms of their outlook and expectations. And so I think, from my perspective, that's one of the areas in which real estate can prove itself to be a great hedge against that uncertainty. That if we do find ourselves in an inflationary environment, real estate has all of the characteristics to, hedge against that, to market the income stream against that inflation over the hold period. And so I think as a result, it's an incredibly attractive alternative to fixed income at the moment. That if we're right, the spread against bond yields will be very attractive during the hold period. And if we're wrong, then we will have the ability to market against that inflation over the hold period down the road as well.
Yeah, I mean, it's such an unusual environment where we've got rates so low and we've got so much stimulus coming into the system as well. So let me ask you then, we are seeing a lot of capital that's flown into real estate. We're seeing cap rates look incredibly defensive across most asset classes. Obviously, we're seeing some softening in some of the more impacted asset classes like retail and hospitality. But where do you think we are from an allocation point at the moment? Do you think that big investors globally, pension funds, are under-allocated to real estate?
Yeah, I do. And look, we, Brookfield, certainly do more broadly as well. We saw this in advance of COVID, where there was the beginnings of a secular fixed income allocations into alternatives that had a number of sort of safe haven characteristics that made them a good complement to a fixed income portfolio that was frankly failing to meet the return expectations and objectives of institutional investors. And so that wave of capital was already beginning the transitionary shift into real assets. And, it's a trite truism that gets pulled out at every conference at the moment of COVID accelerating trends. Look, this is another example of that. And so as we see interest rates really having bottomed out at the moment, it continues to be an incredibly attractive asset allocation story. And so in addition to, the traditional real estate investors, who will be listening into this conference at the moment, it's my expectation that there will be a whole host of newbies who are coming out of their fixed income portfolios into real assets. And that's very hard to see that trend slowing down.
If you got a number, what do you think is the right percentage of any portfolio that should be allocated to real assets, or even alternatives for that matter?
Well, look, so as a highly regulated institution yourself, I'm going to caveat anything that I say and try to sort of dance around your question. Look, I think it really does come down to the portfolio characteristics that somebody is looking to achieve. And again, as a real estate investor, ourselves, frankly, there is a whole host of opportunities across the risk spectrum. And so to the extent that one is, really indifferent as to whether their returns are generated from capital appreciation or income, the opportunistic space at the moment creates, tremendous opportunities coming out of the recession that we've seen. At the same time, more fixed income like real estate core product is a great alternative to fixed income. And so therefore, when an investor is undertaking their sort of question of portfolio allocation, I think that we'd expect to see a large percentage of that fixed income portfolio transition across to real assets and real estate in particular. So the larger the number that somebody had allocated to fixed income, the larger share of absolute dollars I think we're going to see flow into real estate in the next couple of years.
A long runway then, and I should just say at this point, if anyone wants to call up and give me billion-dollar orders to buy undervalued listed real estate, I'm very happy to talk to you. So I mean, and I guess you Brookfield have seen that as well in terms of inflows, right? I mean, I know that we've seen inflows into a lot of big asset managers from Blackstone through Cohen and Steers. We've seen GIC obviously make some very significant investments recently, and we've seen a number of private equity firms make bids for listed real estate assets. So is that what Brookfield is seeing at the coalface as well, new inflows?
Yeah, absolutely. Absolutely. I think, both from an institutional perspective, where again, just the absolute dollars tend to be larger. And so we do have a number of those kind of active conversations underway. And I'd say that's the broad theme that we're seeing. Equally for, retail investors, to your point about the listed space, I think we're seeing that as well. I mean, it is a yield-starved environment at the moment. And for the retail investor looking to construct their own portfolio, thinking about their own retirement, they're dealing with exactly the same issues at the moment.
Okay, so let's turn to what that money wants then. Certainly from where I sit, it feels like all of that money is looking for logistics and data centers. At some point there must be a trade into retail. What do you think that money is looking for, and what do you see that when they come to you?
Yeah, look, it's a great question. I think for the two asset classes that you mentioned, there's certainly the flavors of the month, right? When we think about data centers and logistics, there continues to be very strong demand from the client perspective. And again, that demand drives new development, new supply, new capital allocation. And so that's playing out. Of course, there is the risk that at some point in time, we overshoot the mark, right? And we see more development than there is supply, and welcome to the business cycle again. What I would say in particular for those two asset classes is that it does require a certain degree of expertise, to say the least, right, in order to develop new product. And therefore, what I see at the moment is more press releases of capital allocation than capital actually being allocated. And so I do think the fact that it requires a lot of expertise to actually build a new data center, to acquire all of the permits, put in place, everything that necessitates a successful product, mean that there will be some elements of sort of self-regulation in terms of the development of that asset class over time. But, again, to your point, this was a perfectly leading question. As everyone is focused on the bright, shiny object, it creates opportunities in some of the less loved asset classes where, retail is the perfect example. I mean, there is no such thing as an average return in retail space. And you can have two shopping malls located directly across the street from one another with very different return profiles and traffic generating capabilities. And so for an investor like ourselves that's operationally focused, that's an incredible opportunity. That if the two of those projects are trading at the same inferred value and the return profiles are going to be vastly different, we can separate the wheat from the chaff and hopefully, earn above average returns. And so, for us, when we're looking to assemble our sort of global portfolios in real estate, we are focused on, on both of those opportunities. One is, riding the secular shift into asset classes like logistics. And the second is, as I said, sort of separating the wheat from the chaff on some of those unloved asset classes like retail.
Yeah, like you said, right, you need a skill set to be able to do that without it all going horribly wrong. I'm curious as well. We touched on the sustained interest rate climate that we've been seeing. Have you needed to change your return hurdles at all?
We have not. But what I would say is that, again, on a relative basis, having kept our return expectations relatively intact, the spread relative to risk-free is certainly widened. And while we continue to hunt for opportunities that meet those returns, what we are seeing in the market is, the beginnings of cap rate compression, where asset prices relative to fixed income yields are compressing, and in particular for some of those asset classes that are seeing enhanced interest, logistics being the perfect example. Why should there be, a multi-hundred basis point spread for a high quality logistics facility that's leased to an Amazon or a Coupang, for example, relative to an office building with the same 20-year lease for that tenant in place? And so I think, some of that relative spread that's existed and persisted, frankly, in the past is now starting to compress over time.
Certainly been some very big moves since I started out as a lowly logistics analyst 20 years ago. All right, from our side, we're also seeing around 20 to 30% of all inflows this year coming into funds that have got some kind of ESG overlay. How important is that to you and Brookfield in the context of what you're doing?
Yeah, look, it's critical, and I think for E in particular, people may not be familiar with the fact that Brookfield has one of, if not the largest non-governmental owned renewables businesses in the world. So we're a large investor in hydro, wind, and solar in particular, and have been for almost 100 years. And so, the focus on ESG, frankly, is nothing new for us. And we're very fortunate to be able to say that it's been a focus of our business, long since prior to this becoming popular. But I think it is, tremendous to see all participants in the investment process at the moment sort of focused on these goals. It really allows investors like ourselves to sort of, to focus on what's important, in particular coming out of a global crisis like what we've seen in COVID. That where there is an increased focus on sort of all elements of this, and certainly the E as it relates to climate change at the moment. So, I think it's a tremendous focus. And for us, it's really about embedding all of those decisions in the entire life cycle process, the investment process that we have underway. And in our case now, I was just going to say that that's embodied in our case, Sarah, with one individual, Mark Carty, who's joined us as the vice chairman of Brookfield to oversee all of our ESG initiatives across the entire global business.
I'm curious. So I was just going to ask. I'm sure you sit on plenty of global calls, as we all do. But what is Brookfield seeing? You talked about from the investment side and from your own point of view, but what about from a tenant point of view? Are they driving change now as well and demanding certain standards across Asia specifically?
Yeah, it's coming. I think the challenge with multinational corporations, as you know, is that change does not come instantly. And at the same time, they're all looking to drive some level of consistency in terms of what the ask is. So, it starts initially with an open-ended question for, of their landlords, their investors, their partners, which is, what do you think of ESG? Hoping to elicit some feedback and information that, that they can sort of feed back into their machine to drive a more pointed strategy. What we will see over time, and are starting to see some of those forward-thinking multinationals do at the moment, is really start to put criteria of measurability and the like, for all of their, office requirements and the like across their global portfolios. And I think, that is really one of the key initiatives that all of us will be focused on in the next little while is measurability. I mean, it's very difficult to drive change unless, one knows where you're starting from. And having some level of kind of consistency of reporting and the like in that regard is critical. And so we're sort of focused on all of those initiatives like GRESB and beyond.
Okay, so taking all of that you've just said into account, if I was to give you a mandate today with $10 billion to spend and full discretion on what you did with it, where and in what would you look to deploy it?
So great segue. Listen, we're actually launching a fund, so we would happily, take your capital in that regard. But we've announced obviously a global transition fund that Mark and our renewables team in particular are going to be focused And in that regard, the investment thesis is that there's lots of opportunity to drive measurable change and deliver on two key factors for investors. The first is true carbon reduction that we can measure and deliver upon, and the second is do that while still earning attractive investment returns. And so it's our view that across asset classes and sectors there's going to be opportunities like that, and we think that it's just going to require a tremendous amount of capital to drive that change over the next decade and beyond. And we're going to be able to do it all the while earning attractive investment returns.
Okay, but still, we're looking at the returns that you see today. I mean, give us just a 3 minute or 2 minutes. We only have a few minutes left. Just Australia versus China versus Singapore versus India. I mean, where is interesting to you or most interesting to you at the moment?
Fine. If we're going to put pins on the map, look, I would say that there's a couple of markets in particular. Like the U.S. is always a great area of focus, and I think there just continues to be lots of opportunities to put capital to work in that market. Looking globally, India and China are both very attractive high growth markets. India, continuing through its challenging deleveraging campaign at the moment. Lots of opportunities to drive distress and operational returns. China, it's a very strong growth market, and lots of investments as it sort of transitions towards a carbon-free future. So, I think 3 great markets to focus on, and then, the benefit about being Brookfield at the moment is we can diversify that across the world. So I can give you my answer, but we're constantly ready with capital at hand in any one of the markets to the extent that I'm on.
Do you have a pet asset class you prefer at the moment on a returns basis?
I'm gonna be deferential on that one. Look, I think this is an opportunity to assemble. This is a time to assemble a diversified portfolio. Lots of tailwinds behind popular asset classes like logistics and data centers. I do worry that we get over the tips of our skis from a supply perspective in specific markets there. And so the best way to offset those are to invest in some unloved asset classes as well at the same time and build yourself a great diversified portfolio for the next decade.
Okay, great. Well, we're almost at time, so I'd love to finish with some rapid fire questions, if that's okay. Very, very short answers. So what are you most excited about?
Travel.
What are you most worried about?
Inflation.
Okay, what's your favorite restaurant?
The favorite restaurant at the moment is one that I can't visit in 4 or 5 cities around the world. So my favorite restaurants in Shanghai at the moment have had too many visits from me over the last year and a half.
Okay. How active will we see Brookfield in the listed markets in the next 2 years?
I think very active, both on the listed side and then certainly I think, some opportunities where we, continue to see pricing discrepancies between public and private markets.
Okay. And will you be a net buyer or seller of real estate in the next 2 years?
Buyer.
For Asia. When will borders reopen?
I've done my part. I have dual vaccines, so I'm ready with my passport at hand. I'm hopeful we're going to be on the plane before the end of the year.
Oh, me too. All right. With that, Stuart, thank you so much for your time today.
Thanks so much, Sarah. It's a pleasure to be with all of you.
All right. Thank you so much, Sarah and Stuart, for making the time to record this. I'm also, like Stuart, very excited for travel to resume. So I hope we all do our part in getting our vaccines. They're available. So lots of opportunities. And our next session is a panel discussion among industry heavyweights, and they will be discussing the rising investments in Asia Pacific. I'm pleased to introduce Greg Hyland, who's the head of capital markets for Asia Pacific at CBRE. Greg will be our moderator for our panel this afternoon. So if we have Greg on, I'd like to hand it over to you.
Thanks, Sigrid, and welcome everyone for this afternoon's panel discussion. The topic is increasing deployment into Asia-Pacific assets. I think this afternoon we've assembled a stellar lineup of industry veterans. Firstly is Suchad, who's the chairman and founder of SC Capital Partners, and Brian Chinapi, who's the partner and head of Asia-Pacific for Actis. I think generally speaking, when you speak to most institutions, they are well under-allocated in real estate. And in fact, some of their target allocations have increased over the last couple of years. And they're increasingly look to actively deploy into various different strategies across Asia Pacific, both on a direct basis, indirect basis across the capital stack. Just to put in some context around the size of the Asia Pacific market, our research team has provided some stats. They estimate that the total investable stock in Asia Pacific is $8.35 trillion. In some context, the US market is $13.1 trillion. I think as a starting point this afternoon, we want to look at what the capital raising environment's been for fund managers over the last 18 months. So I might start with you, Brian. How have you found it with your LPs? And what sectors in particular have they been looking to allocate, and what challenges have you had?
Hi, Greg, and thanks for having us today. I guess the last 18 months, I would really divide it probably into 3 6-month chunks. The first 6 months after COVID, I think most investors were kind of just like the managers, the GPs ourselves, were kind of figuring out what was up and what was down, and how much impact on our existing portfolios and managing through that. And so not a lot of looking for new investment opportunity. I think the second 6 months it started to change. I think there started to be an appreciation that Asia was more resilient, and I think we're still seeing that. And so in some sense there may have been a little bit more interest in Asia, although I would say not yet ready to make a move, but discussions kind of more significantly happening. The only exception I would say to that is Asian investors. I think Asian investors really for the last 12 months have actually been quite active in Asia, taking advantage of focusing a bit more on home. And in the last 6 months, it's really, I wouldn't say it's business as usual because the travel is difficult, but we've seen a lot more interest in our strategies. We've seen a lot more interest in the region. We've seen willingness for investors, LP, to do things remotely. So not quite back to what it was pre-pandemic, but the interest level has picked up quite substantially.
And Brian, the obvious darling sectors with regards to logistics, data centers, and multifamily, have those played out through the discussions that you've had with capital partners?
Yeah, multifamily a bit less for us because we're not active in Japan or Australia, which is where the bigger markets for that sector are in Asia. But certainly logistics and data center. In the beginning, nobody was interested in office; it was dead. Retail the same, hospitality the same. I think that's changed a lot. I think the pendulum has started to swing. The darlings have remained logistics and data centers from our perspective, but we're also hearing concerns around the perhaps are we getting ahead of ourselves in terms of pricing. I also see now some more interest in office. Is there deep value office, and even is there deep value retail that perhaps is more focused on essential services?
And what's been the discussion with regards to developed Asia, developing Asia, and gateway cities versus, I suppose, emerging cities? Has there been a trend that investors have that you've seen from investors?
I think maybe marginally more interest. Probably haven't seen a huge shift there. I think probably where we've seen more of the shift, which is perhaps causing a gravitation to more emerging Asia, is the interest in build to core, and the story around the creation of income and the opportunity to sell that income into a very increasingly deep income buyer, which is that's a newer story in emerging Asia than certainly is in developed Asia. So I think that is creating extra interest in the emerging markets.
Suchat, if I might bring you into the discussion. I know your firm is extremely active across multiple jurisdictions. What are your LPs telling you, and how have you found the capital raising environment?
But I think we have slightly different dynamics from what Brian had mentioned earlier, partially because we as an organization, we don't really have an offices in New York and London and different places. So I think when the travel restriction is pretty much restricted for us, extremely restrictive, our fundraising would actually, put it this way, go on the sideways a little bit, but we do have sufficient capital to invest whatever we needed to do. So we're quite fortunate in that sense. And LP in Europe basically said, look, if anything, we look in Europe first, and we might look into America. North American LP said, if there's anything we can do, we can only do the US first. We can't do in Asia Pacific. So we didn't actually spend that much time besides just updating them what happening in the market. But there are also interesting capital sources that came and approached us on a co-investment basis. So that ton of capital rounds, except the traditional, our pension fund endowments, foundation, and also the public pension plan. They tend to be a bit on the wait and see size. And then the Asia Pacific based investor from Malaysia, Korea, and all that are beginning to pick up only sometime this year. So that's what we're seeing. In terms of the activity, I mean, I would just say the bigger distress that has created around hospitality and retail assets. So with that too, we're focusing more on hospitality, and then two hospitality market that we're really quite bullish on with Japan and Thailand. So we're going to be focusing on that. The rest of it, I think Brian had touched on, data center getting a little bit, I wouldn't use the term crazy yet, but I think everyone in the street know how to spell and invest and do data center. That's the impression I get. You talk to everybody, they seem to be going to data centers. So that concerned me a little bit. I think you've got to ask yourself, what do you really have in an edge? Again, are the people in that sector? I mean, and then if the return was not attractive, why you want to do it? I know that the pandemic had show up a very, very good dynamic for data center because people go online, and so the cloud players are getting quite big and all that. But at the same time, the opposite force was that the cloud player getting so big. I mean, in the past, you build data center, you have 150 clients. Today, you build data center, you're talking to 8 of them. And then 8 of them, a huge amount of bargaining power in you, and then the other 130, 40 already folded into that 8 of them, So that dynamic is very interesting to watch. We prefer right now at this point in time, or probably on the logistics side, and then on logistics, we couldn't invest enough to be honest. Opportunity also getting a bit tough. We only managed to do build to core in China in volumes, also in Korea a little bit of volume, but Japan it's tough to get even for 2 deals that we have on, and Australia and New Zealand also getting quite tough. So that's where I leave it. And traditional multifamily offices and all that are hardly being impacted by the COVID as much as the retail and hospitality. So I think the distress in that space, not that large. I don't know whether Brian concur with me. And then I think the other thing that we have found good result with Brian and Dan also good result with where we go to some of the emerging market and get good outcome out of it. But it not SAI. You can't get SAI investing in Vietnam. You can't get SAI investing in kind of South Asia per se. If you want SAI to Japan, South Korea, China, that where you can get SAIs. Or Hong Kong.
Brian, I might pass that back to you. How do you look at developing Asia versus developed Asia in terms of your deployment and strategies at the moment?
I guess the easy question for us, because we refer to our market space as kind of growth Asia. So it's really where we're focused is China, South Korea, India, and then some selected markets in Southeast Asia. But then within that, we have kind of cities that are actually quite developed. And so we do differentiate in terms of how much we're putting in kind of the cities like Seoul or Beijing, Shanghai versus some of our cities that are a little bit less developed. To me, what's actually most exciting about the growth part of Asia is you've got this interesting arbitrage between, being invested in a country overall economy that has many developing market characteristics, yet you're actually investing in cities that are pretty highly developed, whether from an infrastructure perspective or a wealth or employment opportunities, et cetera, for the population. And so one of the big trends that we actually follow, which kind of generates demand across all of the asset classes, is not so much urbanization in our markets, but it's really this densification of wealth in the cities that we see happening. And so that's kind of the markets where we see those trends the strongest is where we're investing.
And Brian, Suchad was making some comments around the data center space and the amount of, I suppose, activity and capital that have been allocated towards it. Your firm's been a sort of early adopter and active in that space. How have you seen the returns over the last 18 months with new money, new investors, chasing exposure?
Yeah, look, I think we like the space a lot. It has heavy barriers to entry, which is also why, though, I think a lot of money is going to be lost in the sector as well. Now we started our entrance into China back in, I think it was 2015, so we're a very early mover. We really started entering Korea just in the last year, but it's work we've been doing for almost 3 years. So we're early mover in that market as well. I think we've learned a lot over that period of time, and what we have, I think, learned that's held us in the best stead in that space is it's, at least in Asia, it's proven to be really you need a combination of the real estate development skills, how to deliver on the ground. You need to understand the power equation really well, and it's helpful that we're part of the broader Actis, where power is actually one of our biggest businesses, and so we can bring that to bear, particularly in the data center space, and also the sustainability angles with renewable power there. And then the third piece is then understanding that data center ecosystem itself, and so bringing those together has proven important for us. I think there's a window of opportunity. I'm not smart enough to know exactly how long that's going to last, but we're relative value players across multi sectors, and we're definitely emphasizing that space right now. We're very confident that we'll have a lot of capital to sell into, and we'll see how long the so to speak the capital gain opportunity lasts in that space. But I think it does have some legs if you understand how to maneuver those pretty significant barriers to entry.
I might switch now to ESG, and I suppose from a couple of factors is ESG. What are your investors telling you, and how are you responding to that? And then when you're looking at making investments in the market with the lens around sustainability and the assets that you're looking versus, I suppose, some of the commercial realities of delivering sustainability, how is your firm addressing those issues at the moment? I might start with you, Brian, as you're on a roll with the data centers.
Yeah, I mean, the sustainability piece is an important part of Actis's DNA, and it's been a big driver of our energy business, which is mostly in the solar and wind space, so all about renewables. And so we've also, obviously adopted that, not obviously, but we've adopted that in the real estate space as well. I think COVID is in some ways accelerated the importance and the interest in it. It's probably given a bit more lift to the S piece of ESG than where real estate's been probably more focused on the E piece. So for us, it's clearly the biggest focus in the real estate space is on the environmental aspects and how we can have a greater impact on climate change. The data center space is probably the low-hanging fruit for us, and we have a very strong view that yes, data centers are big users of power, but they're still better than everybody storing their data in their own cabinets on their office floors all over the city. So there's actually an ESG positive efficiency to data centers, and then there's a whole efficiency to how you build them, and eventually, the holy grail is the renewable energy aspect. So we're very focused on bringing that specifically to our data center platform.
So Chad, I might bring you in. How's your firm addressing ESG from your investor base, and then when you're looking to deploy their capital on their behalf?
What we have kind of get a feedback from our investors, generally speaking, said, please, we are, and this is I quote some investor, and I wouldn't quote name, but they said essentially we have an ESG committee on our back to making sure that every fund manager that we invest with has some ESG policy. So please do whatever you can to comply, make my life easier. So I think that is something that we would like to invest with you. So they are very frank about it. But when you ask them whether the ESG is going to cost you about 150 basis point or 50 basis point, would that be okay? Because you need to buy carbon certificate to offset to make it zero carbon and all that. And many of them will just say, whoa, it's okay, you can reduce some return, but please don't make it a big chunk of it, because we still need the performance. So that, I don't know whether Brian felt the same, but I felt that investors tell us that please, return is still important, but please get on ESG. We haven't got to the point where I think that Europe will get to that point where ESG would have to be within your DNA. You must have a solid plan by 2035 or something that you're going to be zero carbon. The question I always have is that it's a very cynical view of the sustainability. You kept building more of the renewable energy, kind of like you are building more wind turbine, you build more solar cells. You're basically creating electricity and encouraging people to use more, but it's clean energy, but you're still encouraging people to use more. Actually, not that many people focusing on, let's say, for example, data center, you use 30 megawatt, and whether you can find a technology breakthrough that can lower your cooling by 60-70% of some sort. And that part of thing that I haven't seen anyone come into that part yet, but everyone seems to be saying that okay, you can use the 30 megawatt, but please use clean energy. But no one is looking at it and said that 30 megawatt, can we achieve the same thing with using 15? And that's something that no one is focusing on, because if you really want to focus on sustainability and green, you should be focusing on using less energy and not using more and expanding your business that way. So I felt it a bit of contradictory there. As far as we are concerned, that only two ways you participate in this ESG. One, you are the user of the carbon credit mechanism, and then the choice of your energy use, or you will participate and actively be in the project where the carbon certificate are being generated. And if we can help it, we would like to be the second type. And the second type, it means that we just have investing into project, into part of project, into not renewable, but into something carbon capturing, into something methane capturing, and some of that creating huge amount of carbon certificate. Because one day today carbon certificate $15. What happens if you promise yourself that you're going to get zero carbon, but carbon certificate might go up to 150 per ton? What will happen then? Will you still continue to stick onto your zero carbon certificate and at the expense of your return? That's the question that nobody answering it right now at this point in time. So I think it's still, I wouldn't term it all over the place, but directional is clear, but how to get there is unclear.
Brian, I might bring you in. How does your firm balance that tension between delivering sustainable outcomes and the cost of offsetting carbon? Because the reality is that real estate's a huge consumer of energy globally, and it's there's that challenge, and a lot of companies have picked it up to be carbon neutral by 2050. Seems to be an increasingly consensus date. How do you going to manage that tension between, I suppose, near-term returns and delivering the sustainable outcomes that the investors are looking for?
Yeah, I mean, we're seeing, from our investors, we're seeing the same thing. I think Sujat is saying is that if we told investors that, we're going to do all of this suite of things under the umbrella of sustainability, and it's going to cost you performance, that would be a non-starter. The good thing, though, from our perspective, is that you don't have to make a choice. And that you can, and that a lot of what we're doing in sustainability, particularly around the climate change initiatives, is all around, because 80-90% of our business is built to core. Our view is if we're not doing these things, we're not going to have durable income streams because tenants aren't going to want to be in the assets, and we're not going to be able to sell these assets. So it's, it's a necessity, and it's very much, linked with performance. But you have to be careful, right? You have to be careful around what aspects you're going to adopt and what you're not going to adopt. I guess the good news from real estate is that, as you say, Greg, we're, what is it, 50% or so of carbon emissions coming from real estate. The good news is that there has to be a reasonable amount of low-hanging fruit there to make an impact, given that it is such a contributor to carbon emissions. And so, I think there's a handful of investors that I've spoken with that may agree that to pay that 150 basis points of return for more sustainability, but it's very much a minority, and it would tend to be more in the kind of the DFI world than the more traditional investors that are kind of managing stakeholders for long-term returns. Then on data centers, the only other comment I would make on that is I do think, in some ways the data centers, the low-hanging fruit has been taken out. And so actually for very efficient, well-built, well-operating kind of modern data centers, we actually have reduced energy usage by almost 80% in terms of technology. And so data centers used to consume a lot of power in addition to the IT load, almost to 1.8 times the IT load. Now the better facilities are running at below 1.2, and so there's been a lot of work that's done in that space. I think the next evolution is probably what Sujat is talking about: is how do we get more efficiency out of the IT load itself, and which is something we think about in terms of obsolescence of data centers, and why our program tends to be more focused on more urban sites that are a little bit more irreplaceable, as opposed to the far-flung suburban locations, which we think will be much at greater risk of being obsolete by advances in technology.
So, Chad, you touched on earlier the sectors to deploy capital in. I suppose during COVID, there was a lot of expectation that real estate values would correct. That was very short-lived, and some of the, I suppose, COVID winners like logistics and data centers have continued to outperform. How are your investors, and how are you assessing the look-forward returns on the winners through COVID versus, I suppose, some of the laggards? And you mentioned hospitality, and where's your firm going to be focusing?
I think in terms of even data center logistics, in order to find opportunity to build to core, I think there are still opportunity around for you to get probably 15 to 18% levered returns and solid underwriting. And then you can part it on to the core and probably 3 years, the multiple 1.6 or some sort, levered by, you can do that. In China, you can do that. In Japan, you may be a bit tougher, but you still can get the mid-teen return. So I think from Brian's perspective, the Brian running a bit more value-added, wherever I'm on the opportunistic side, I still see that opportunity, and we've done probably about 10 transactions on that on logistics side, so we'll continue to try to do more of that. On data center, we have found something that's about 18-19%, so not so bad, but of course, I think this thing much more creative earlier on in the 4-5 years ago, but today, this is what we're competing. I think in terms of the real distress, that only 2 sectors I mentioned earlier that really have a real distress, and this is hospitality and retail. Particular high street retail that have been really taken out of context in the sense they're totally disrupted by the online and all that. And then with the lockdown in the city center, many Asia Pacific retail had really suffered. Hospitality, it's the class that have been probably most distressed. You probably have seen 20 to 40% of hotels have been closed down at the peak of the crisis. So that will give you some scale of what the actually magnitude of distress. Despite the government forbearing, despite the banking forbearing, someone will still have to pay for the last 2 years of underperformance and the next 1 year of subpar performance. So if you're a hotel owner, you have to pay for 2.5 to 3 years of probably very, very below break-even point of cash flow. And if you're not distressed, I don't know how you call that, okay? You may not have to be selling at distress, but there will always be an opportunity. The initial reaction might not be, but in the next 18 months, people will realize that there's some other alternative deployment of capital elsewhere, so they actually are willing to sell. We are beginning to see that happening in Japan in big scale. We've seen portfolio of 7 hotels, portfolio of 8 hotels that coming up right now at this point in time that are selling, and then they may be trading at about probably not at 40-50% that you were hoping, but it may be about 18 to 25% below where the pre-COVID level. And with the cost structure coming down, that probably tend to amount to about 25% discount. And I think in today's environment, with all the return at this level, it probably decent return, to take risk for the next 2 to 3 years, and that's what we are focusing on right now. And then, that's where I would say the opportunity are at the moment.
Brian?
Yeah, I would agree. We don't have an expectation. We haven't seen any significant distress, nor do we have an expectation that will be a meaningful investment opportunity in the region. That being said, we are seeing pockets of some stress, but these are really themes that were pre-COVID that have been again, another one of these stories exacerbated by COVID, and that's really in 2 pockets. It was deleveraging that was happening with some of the the non-traditional owners of real estate in China, and so we're seeing some stress, ability, kind of deep value buying of existing assets for repositioning in Tier 1 China. And then in India, where there's a delevering that was going on really from the, still about 2 years back of the pullout of the non-bank financial institutions that some of the developers relied on a little bit too much, and so there was some stress that was created there. But that was really independent of COVID, only enhanced by COVID as a result of the length of the COVID impact. The other question I get asked a lot is kind of how to compare that to the Western, more developed markets, where they're maybe a little bit less so now, but earlier on in COVID, there was a view that there was going to be all this low-hanging fruit of distress, and how does that compare to Asia, where there was no distress? And my view has been, well, we still haven't seen that distress in the West yet. But I think where Asia still holds a bit stronger is that we don't have to make any major decisions around structural changes. Whereas in some of the U.S. cities, there's some real views that need to be made around, what will they look like post-COVID? A lot of that's actually driven more perhaps by tax situations than it is, the impact of remote working and COVID specifically. But it seems to me that there's a lot more structural shifts that are being considered in the Western markets than we have in Asia, where we expect that the dominant activity will remain within the CBDs, within the cities, and so kind of less kind of big picture calls to have to make in that sense.
I might move on to what keeps you up at night. Where do you see the risks, I suppose, near term and medium term? I mean, the economy, most markets are awash with liquidity, both on the equity and debt side. What worries you, Brian?
Well, I think the question is what worries me, which is the amount of how do we find opportunity and not get kind of taken down by this kind of wave of liquidity that's coming, and so continuing to find the arbitrages and kind of working with that liquidity versus against that. And right now we still see that opportunity, but remain mindful of that is probably the biggest risk that we're seeing. I think the second risk is just the geopolitical aspects. Do they I think one of the things we have to recognize in Asia is that we probably will see more versus less geopolitical risk, and we just have to factor that into our investment decisions. The way we manage that is to go more and more local in terms of what's driving demand and what's driving exit.
I think for me, that phase of what keeping me up at night, it's over now. This is basically because we do have a lot of property, and then the COVID in some of the market was really quite poorly managed. So in that sense, I think we were concerned about our own staff being caught COVID, and also our shopping center, our office building, with the caught COVID and being asked by the government to close, and hotels as well in that aspect. So I think we were quite concerned about that for quite some time, and almost the firefighting, but that phase is absolutely over now. So we're now moving on to the next phase, and then the next phase for me is that what really is relevant coming out of this. I do believe that where you find the opportunity, where to be sensible, is very, very important. I think we don't really have a lot of single asset due to COVID to any lender for any reason, and that probably came to the fact where we are probably the only opportunistic fund that running at about 48% LTV loan throughout 17 years. So we don't really get that level of challenge per se. We don't hand the key in and all that. But so I think that part is not an issue for us. Issue for us, the next thing is that where are we going to deploy significant amount of capital that we're going to raise on, and then whether we're able to find the platforms or find it in-house expertise to be able to deploy them, and that's something that we're waking up at night every day and thinking about it.
Great. I think we're coming close to the end of our time. So I suppose one question from me, we've all been sitting at home, haven't been traveling for long periods of time. Brian, where's your first trip?
I'm leaving on Thursday to the US, so looking forward to that.
Holiday or business?
Both.
So, Chad?
I'm waiting for the first trip to Europe, and then after that, we'll Japan.
Excellent. I think that's to the end of our time. So unless anyone else has got further questions, I think, Sigrid, we can finish there.
All right. Well, thank you so much, Greg, Chad, and Brian. It was a very good discussion, lots of great sound bites, and I'm very happy to hear that there remains a great appreciation for our region's resilience. And so keep that confidence up. And so thank you once again. For our next session, we have organized another special fireside chat. We are honored to have Dr. Alex Edmonds, who is Professor of Finance at the London Business School And he is also joined by Brian Salder-Gill, who will be introducing him. Okay, Brian is Managing Director of Real Estate at KKR and a board member of our APREA Hong Kong chapter. By the way, Alex is the most sought after speaker, and so we're very pleased to have him. And thank you, Brian, for making this happen for us. All right, and so I'd like to hand these over to Brian and Alex.
Online. Excellent. Alex, welcome. So everybody, we have a treat for you. We have Professor Alex Edmonds online for our second and final fireside chat today. This is a real treat. Alex is a professor of finance at the London Business School. Alex has a PhD from MIT as a Fulbright scholar and was previously a tenured professor at Wharton and an investment banker at Morgan Stanley. Alex has spoken at the World Economic Forum in Davos. He's testified in front of the UK Parliament. He's given the TED Talk, What to Trust in a Post-Truth World, and the TEDx Talk, The Social Responsibility of Business, with a combined 2.3 million views. He serves as Mercer School Memorial Professor of Business at Gresham College, giving a 4-year program of lectures to the public, and on Royal London Asset Management's Responsible Investment Advisory Committee. Alex's book, Grow the Pie, How Great Companies Deliver Both Purpose and Profit, was featured in the Financial Times list of business books of the year for 2020. He's been named to Poets and Quant's Best 40 Professors Under 40 and Thinkers 50 Radar. So with this, I'm tremendously pleased to welcome Professor Alex Edmonds to speak with you all today.
Great. Thanks so much, Brian. It's really great to be here and have the chance to share my views on responsibility with you. So what I've entitled my talk is The Power of ESG Investing. And I think for many years, ESG had been seen as something which was quite niche and quite specific. But what I like to highlight is just how general it is, how important it is for wider society, and also for shareholders, not just something for an SI department. I am showing my slides here, but I just can't see it within the app. So if you could just let me know if you can't see it for some reason, that would be great.
They look good.
Okay, great. Thank you. Okay, so I'm going to start by explaining what I mean by ESG investing. And you might think, well, that's kind of obvious. Don't we all know what ESG is about? But actually, I'm going to have a quite different view of ESG to what you typically hear. And to do this, let me start with a story. So I know it's been a long day. So instead, I want to take you outside of your home offices on a little bit of a journey halfway around the world. So I'm going to take you to the Great Rift Valley. So this stretches across 2 continents and 6,000 kilometers from Lebanon and Asia to Mozambique and Africa. And it has some of the world's highest mountains, like this one, but also some of the world's deepest lakes. And one of these lakes is a lake called Lake Magadi, which is in the Kenyan stretch in the Great Rift Valley. Now, you might think it's hard to imagine that you're here because you haven't seen it before. But in fact, you might have seen it before, not on the small screen of your home laptop, but maybe on the big screen of a movie theatre. It was featured in the blockbuster thriller, The Constant Gardener, which came out about 15 years ago. And indeed, millions of people around the world have seen this lake because they've seen this movie. But fewer than 1,000 people call the lake their home. And one of these people is a gentleman called Emmanuel Saronga, and he makes a living selling and herding goats. Now, it used to be for Emmanuel that cash was king. So when he sold a goat, he would get some cash, but then Emmanuel had to check that cash in case it was forged. he'd have to store that cash and worry about it being stolen. And then to bank that cash, it wasn't just walking down the high street. He had to walk for an entire day to the nearest bank. So Emmanuel's life was really tough. He couldn't graze his goats in the greenest pastures. He always had to be within one day of a bank. But all of that changed due to a responsible business. And that responsible business was Vodafone, the UK telecoms giant. Because in 2007, Vodafone launched M-Pesa, which is a mobile money service in Kenya. So let me briefly explain what mobile money is, because some people think it's mobile banking, where I have a bank account and I can operate it on my phone. I don't need to go to the branch. But actually, with mobile money, you don't even need a bank account to begin with. You can just transfer money from phone to phone. And that was really powerful because in 2007, 15 million Kenyans had no access to the banking system. So this completely transformed Emmanuel's life. So he no longer needs to deal with cash or worry about robbery or forgery of money. He can graze his goats wherever he wants to, and he has a record of every transaction on his phone. But more importantly, it's not just about him. A large-scale study found that within the first 7 years of launching M-Pesa, 200,000 households got lifted out of poverty, and many of them were headed up by women. It allowed them to move from agriculture to business and retail. So that's one story. I'm going to tell you about responsibility. But I'm now going to tell you a different story. And this different story surrounds tax. Because in 2012, Vodafone launched a tax transparency report showing how much tax they were paying to governments worldwide. And that's really important in telecoms because you could choose to locate your licenses in low tax regimes. So I've got two questions here for everybody to think about. First is, which of these two decisions, launching M-Pesa or tax transparency, created more value for society? The second is, which of these decisions, if it had not been taken, would have led to the most public outrage or worsened Vodafone's ESG rating or reputation? And I'm not going to poll anybody here because I'm pretty sure that most people would agree with the answers. So which decision created most value for society? It was the first one. Right, by launching M-Pesa, Vodafone lifted 200,000 households out of poverty and contributed to gender parity. But let me now turn to the second question. What would have been the outrage if Vodafone had not launched M-Pesa? It would have been nothing. Right, you don't get slammed by the media for not launching an innovation. There would have not have been a customer boycott for not coming up with this crazy idea of banking without a bank, because nobody would ever thought it was possible to begin with. But what is the outrage of not being transparent about tax? It could be massive. And indeed, Vodafone themselves had suffered a nationwide boycott of their stores a couple of years earlier. So this is why my view of ESG is different from most people's view. So often people think that ESG is about the answer to the second question. Responsible businesses should do no harm. They should not cheat on taxes. They should not mistreat their workers. They should not pollute the environment. And please don't get me wrong, right? Absolutely, a responsible business should do no harm. But you didn't need to listen to me to tell you this. You already knew before this chat that responsible business is not about doing harm. Instead, what I want to do is I want to change our view of responsibility and make it more about the answer to the first question. Responsible businesses should actively do good. Right? Come up with some crazy ideas like M-Pesa, being relentlessly committed to innovation and excellence. So why do I think that? It's for two reasons. The first is the moral reason. Right? The moral reason is, given the challenges we see in society today, automation, climate change, sustainability of soils, and so on, I don't think it's enough for businesses to just do no harm. They need to actively do good and actively address those problems. But the moral case, even though that is important, that is not the only important case. Actually, what's critical is the financial and business case. Right? Because without a clear financial and business case, any company would always see ESG as an optional extra, as a nice to have. So when I come and speak about ESG, I come from the perspective of a finance professor and an ex-investment banker. Not as a professor of philosophy or morals or business ethics. What is really important is the criticality to generate profits and returns, not just social outcomes. And so this is going to be linked to the framework I introduced in the book that Brian kindly mentioned. So you often view that responsibility is about splitting the pie more fairly. Like, we think that the value that a company creates is given by a pie. And you can give that pie either to investors in the form of profits or society in the form of taxes to the government, wages to workers, or fair prices to customers. And as I mentioned, responsibility is about a fair split of the pie. Pay higher taxes than we need to, reduce carbon emissions beyond what would lead to a fine, and so forth. And again, don't get me wrong, fairness and equality is important. But ESG cannot just be about that for two reasons. First, if ESG is about splitting the pie differently, then it reduces profits. And if so, right, then no CEO will voluntarily want to put this into practice. Indeed, we saw 181 CEOs 2 years ago sign this business roundtable statement saying they would serve wider society, but many of them just didn't put it into practice. And why would they? But if responsibility makes you worse off, then let's just not genuinely care about it. Second reason why responsibility can't just be about splitting the pie more fairly is that it's bad for investors. And many people think, I don't care. They like to see investors as nameless, faceless capitalists. Investors are them. Society is us. If we can take from them and give to us, that's good for everybody. But I don't need to tell this audience that investors are not them. They are us. They include parents saving for their children's education, mutual funds, pension funds saving for retirement, and insurance companies funding future claims. So any repurposing of business needs to take investors seriously. Profits play a key role in a well-functioning economy. So this is why I view responsibility as being about growing the pie. Like, we absolutely do want to serve wider society. We want to increase the orange. But the way we do that is not by giving them a greater slice of what's already there, but instead by coming up with innovations, by being committed to excellence, by actively creating value. And the beauty of that is that ultimately investors might profit and the blue might expand. So going back to 2007, Vodafone's strategy was to win spectrum license auctions and expand in the West. That was where there was money to be made. Why would they ever launch M-Pesa? Right, so that's something where there's huge uncertainty as to whether it would ever work. Would they go past regulatory challenges like stopping money laundering? And would the people in Kenya be able to pay for this? From a profit motive, that would have never been something which was positive NPV. But the power of ESG, the power of purpose, is that it opens your minds to business ideas that end up being successful in the long term, but you could not have predicted that profitability and those returns from the outset. So it frees us from having to justify every decision with a net present value calculation. Now, at this point in my talk, you might think everything I say sounds fantastic, but where is the evidence? It sounds a bit like wishful thinking. Well, I'm trying to tell you that companies should just serve wider society and magically some profits will appear, but that seems too good to be true. So this is why my day job as a business school professor is to go through rigorous evidence showing, well, is this something that actually pans out, or have I just handpicked one example because it suits what I would like to show? And it's really important for the evidence to be rigorous because of this idea of confirmation bias. Like, because we like to believe in ESG, any study, even a flimsy one, that claims that ESG pays off will be accepted. So indeed, the TED talk that Brian mentioned, What to Trust in a Post-Truth World, that was about how to be really rigorous and be really critical, particularly when it's an issue we care about, like ESG. This was something that I wanted to study myself about 15 years ago, before ESG became hot. I wanted to look at, do responsible businesses actually perform better, or are they just fluffy companies distracted from the bottom line? Now, the big question was, how do we measure whether a company is purposeful, right? Can we look at their mission statement? Well, we can't, because you might say some nice things and not put it into practice. Well, you might think, well, we can look at, well, how much do they spend on responsibility? Right? Are they putting their money where their mouth is? But that looks at only the input, not the output. Well, as any sports fan will know, a sports team can spend loads of money on some players, but not actually generate anything. And more seriously, some of the great things that companies do to serve society might be to provide employees with a healthy and enriching workplace, to be a great mentor to your subordinates. That's not something that costs anything. So what I wanted to look at was the output, how well a company actually treats society, not just the input, how much they spend. And so what I chose to look at was the list of the 100 best companies to work for in America, which is how well a company treats its workers. So why I focus on workers is that this is a critical material feature in every single industry, right? So climate change is really important, but it matters more in some industries than others, whereas employees are material to every stakeholder dimension. Now, the other important thing was that this was a data set that started in 1984. ESG is a pretty new thing, so most data sets have only been around, let's say, for the past 10 years. And if I showed you that responsibility paid off in the past 10 years or so, you might think, well, those were 10 boom years for the economy, and, well, maybe ESG only pays off in a boom. Maybe right now in a pandemic, we've got to forget about it. So because my data started in 1984, I had things like the financial crisis, September the 11th, and so on, so I could make sure that this was not just a flash in the pan. So there's tons of things that I need to do to suggest it's causation, not correlation. Employee satisfaction leads to better performance, not good performance leading to satisfaction. But I want to make sure we have enough time in the end for the chat, so let me not bore you with all that. I just want to get to the bottom line, which is what's important for all of you, which is that the 100 best companies to work for in America delivered shareholder returns that beat their peers by 2.3 to 3.8% per year over a 28-year period. So this is really powerful, and this shows that responsibility is not just about being fluffy and worthy, it's about delivering long-term returns to your investors. It's serious business. Now you might think, well, that's only about employees. What about the other dimensions of stakeholders, like the environment? Well, I'm going to now look at a more broad study, which looks at all of those stakeholder dimensions. And what's really important here is to think about materiality. So what does that mean? Well, there's loads of stakeholders we'd like to serve, customers, workers, the environment, suppliers, and so on. But there are sometimes trade-offs. So materiality says, who are the most important stakeholders for your industry? And you may have seen this before, but it's the materiality map by the Sustainability Accounting Standards Board. And what this says is what is material will vary from industry to industry. So we look at mining, which is the first one. Right, the environment is really important. If you are Rio Tinto and you blow up Juukan Gorge, that's really bad for your business. But in the financial sector, well, at least your direct effect on the environment is not that high. In contrast, social capital is really important. Selling practices and product labeling, if you're in a Wells Fargo and you have a fake bank account scandal, that is really bad for your business. So what this study did is it took ESG data from MSCI, which is perhaps the best known data source, and it looked at companies that did well on every issue. They did well across the board. And what the study found was they only beat the market by 1.5% per year, which was insignificant. And so that's striking. Like many people claim ESG always pays off, but the data shows that is not the case. But then when they redid the study with a materiality lens, and they looked at companies that only did well in the material issues, and they actually scaled back on the immaterial ones, they did beat the market by nearly 5% per year. So let's just pause to highlight this power of this result, that suggests it's much better to do well on only a few things, not to do well on everything. Right? You don't need to be all things to all people. Just focus on a couple of areas, and that is what responsibility is about, not trying to tick every box. Now you might think, well, what does this mean for real estate? Well, I've given a number of studies from equities, and that's because there's much more data on equities. But in my final study, before I hand back to for the chat, let's look at a few studies on real estate. Now, there are tons of studies I could have looked at, and this person here is one of the leading researchers. I'm only going to look at two. So one was a study in 2010. So why I choose that? It was an old study. It was even before sort of ESG became so popular. And so what I wanted to highlight is even before the interest in ESG, this was something seen to be important in real estate. It showed through in prices. So they found that Energy Star and LEED rated office buildings commanded higher rental rates and much higher sale prices. And this was not just a box ticking exercise. It's not just, okay, you get the rating and therefore you get higher prices, but even within the rated companies, greater energy utilization efficiency led to an even higher sale price, an extra 2% bump over and above the 16%. And also we care not only about the impact on our valuation, but also the impact on wider society. And there was a nice recent controlled experiment where they took one office and then some departments got moved to a new building focused on sustainability and others didn't. And the first group found significantly higher increase in job satisfaction and reduced sick leave. So this is the benefits of healthier buildings on wider society. So I'm going to hand back to Brian for the chat shortly, but just as he mentioned, I wrote this book last year, and why I did so is I think for far too long, like responsibility and ESG were often seen as an optional extra. They had a moral case and an ethical case, but not a strong business and financial case, so it was seen as something which was a luxury. So I wanted to write as a finance professor and an ex-investment banker to show that this is something important, not just for society, but also for the long-term profitability of a business. This is not just based on wishful thinking, but a lot of rigorous evidence. And I wanted to bring this to life in some simple language and some actionable frameworks for practitioners, both investors and executives. So I hope that that might be a resource for anybody interested in responsibility. Anyway, thanks so much to everybody for their attention. Let me hand back to Brian for any Q&A and obviously any from the audience as well.
Well, Alex, thanks a lot for that. That was great. I don't see any Q&A on this in the chat box on the side. Feel free to kind of put any questions in there. I'll kind of kick it off. Alex, from a leadership perspective, you're the leader of a business. Obviously, if you have examples that are specific to real estate, that's great, but not necessarily specific to real estate either. As a leader, what do you think is the most important thing from a leadership perspective in terms of setting the tone for ESG initiatives, prerogatives, kind of goals for a business?
Thanks, Brian. I'd say it's two things. So the first is just to highlight why ESG and purpose are central for the financial success of a business. Why? Because if you're not clear as to why this will ultimately lead to commercial success, then everybody else in the organization is going to really doubt, are you actually committed to this? Or is the leader just saying this because it's good for her image? So as an example, apologies, not from real estate, but Unilever, they're known as one of the most sustainable companies in the world. And they found that the brands that were most aligned to their purpose of making sustainable living commonplace actually grew 69% faster than the other brands. So that's a clear business case for showing why sustainability is important for the profitability of the business. The second thing that I'd highlight is that a leader should also recognize that purpose in ESG is about being focused. So while the company needs to serve wider society, they should understand what the particular priorities are and not try to be all things to all people, because my materiality evidence suggested that actually it's the focused approach which is going to be the more effective one. So if you are, say, an energy company focused on decarbonisation, then you will recognise that that might lead in some cases to some workers being losing their jobs. So you can't claim we're going to serve both the environment and our people, but you're going to pick one particular set as being particularly relevant. So I would just highlight those two things. Number one, connection to the business case. And number two, that what you're focusing on and what might be perhaps of a slightly lower priority.
Excellent. Excellent. Just one more question. ESG was important before the pandemic, but the pandemic, as was said earlier by one of the panelists, has kind of fast forwarded or really exacerbated a lot of trends that were in place even pre-COVID, like the move in real estate, move to logistics. It's been hard on bricks and mortar retail, and meanwhile, e-commerce has really kind of ramped up, so on and so forth. But from an ESG specific perspective, how do you think the pandemic has kind of changed the lens for ESG, or maybe kind of moved the pieces on the board a bit, or just kind of looking out kind of 5 years? How do you think people are going to think about ESG differently maybe than they did pre-pandemic?
Yeah, thanks, Ron. So I think there's three main stakeholders affected by real estate. So one is the environment, the second is occupiers, and the third is employees. I think for the environment, to be honest, that hasn't changed much because that's always been known as the importance of green real estate on the environment. But I think the occupiers is really important. So now that a lot of people spend a huge amount of time at home, then things such as access to green space are really, really critical. So the effect that healthy office buildings can have on well-being is really, really key. And I also think the effect on the employees of real estate companies is really important. Well, a lot of the work now is discretionary effort. So back in my days at Morgan Stanley, you're in a bullpen surrounded by lots of other people, right? It's clear you're not working, so there's a lot of sort of face time there. Now that a lot of people are working from home and might in fact continue to work from home for at least a part of the week after the pandemic, because effort is discretionary, I think a company having a purpose is really important. So if you understand, what are we doing here? We're not just making money as a real estate company for our investors. We're actually creating buildings and we're developing them in a way which is going to help the occupiers and be sustainable for the environment. I think that's something which employees will get really excited about and rally around and continue to put a lot of effort into, even if they are not actively being monitored each day.
So there's one question from the audience I see here now. It says, thanks, Alex. What do you see as the growth for ESG in affordable housing? So I guess that means, how is ESG evolving or growing as an important parameter in the delivery or operations of affordable housing?
Yeah, so I think the question mainly answers itself. So I think affordable housing is a key area. And so I'm now going to put on my non-academic hat. So I serve on the Responsible Investment Advisory Committee for Royal London Asset Management. And so we run 6 sustainable funds. While we don't invest in real estate directly, we'll often provide the debt for it. And one of the key things we're looking at if we're deciding to lend is, well, what is the housing being used for? Is it going to be in London just for a second home for people who live elsewhere? Or will it be in one of the less affluent areas in the UK and be affordable? So I think this is a really important thing, and I think it's something which, number one, they will probably be good from a business perspective. Like what we've seen is if we're having extreme luxury housing, that's something we're in a pandemic where people are not going to be coming to the UK using it as a second place to live, then that's going to be extremely cyclical. Whereas housing which is actually going to be lived in, that's going to be something which I think is more resilient. So from the business perspective, there was a key reason. But I think from a social perspective, when we think about one of the huge challenges that we have is affordability, particularly in some of these large cities where even some working professionals are not able to afford most living spaces. That's something which will actually going to serve wider society. So the use to which it's put to is not only important in terms of resilience, but also in terms of your social impact.
Excellent. Well, Alex, I appreciate it's an early hour there in London. Appreciate you getting up early and doing this for us. On behalf of APREA and all our members, thank you very much.
You're very welcome. Thanks so much for inviting me, Brian. It was great to be here.